Lily, let me tell you a story about a 17-year-old boy. In 1965, he worked as a golf caddy, earned $1 for 9 holes, and every time he got paid, he walked into the bank and did something unusual. He exchanged his dollar for coins, then carefully sorted through them, separating the real silver coins from the fake ones.
Fake coins? What do you mean?
In 1964, the US government stopped putting silver in dimes, quarters, and half dollars. They replaced it with copper nickel-clad coins that looked the same, but contained no silver. This boy noticed that real silver coins were disappearing from circulation. Without knowing it, he was witnessing Gresham's law in action.
Gresham's law. I think we've mentioned that before. Remind me what it means.
Gresham's law states that when bad money or fake money enters the system, good money goes into hiding. When the government debases the currency, people hoard the real money and spend the fake money. That 17-year-old boy was Robert Kiyosaki, and he's been accumulating silver for almost 60 years now. He just did an interview with silver expert Peter Krauth that I want to walk through with you today.
60 years of buying silver. That's serious conviction. But Corey, silver just had a crazy ride this year. It hit $121 in January, then crashed 32% in February. Now it's back around 76. What's going on?
That volatility is exactly why we need to talk about this. Because underneath the price swings, there's a structural story that most people are missing. Silver is entering what could be a historic bull market, but not for the reasons most people think.
What do you mean not for the reasons most people think?
Most people buy silver thinking it's just poor man's gold, a cheaper way to own precious metals. But that completely misses what makes silver unique. Silver has a dual nature that no other metal possesses to the same degree. It's both an industrial metal and a monetary metal.
Industrial and monetary. Can you explain the difference?
Let me put it this way. Iron was the metal of the industrial age. Without iron and steel, you couldn't build railroads, factories, or skyscrapers. But in the information age, silver is the indispensable metal. Every smartphone, every solar panel, every electric vehicle, every medical device, every water purification system, they all require silver. And here's the key difference. When you use silver industrially, it's consumed. It's gone. You can't easily recycle it like you can with gold.
So silver gets used up, but gold just gets hoarded?
Exactly. About 95% of all gold ever mined still exists in vaults, jewelry, or bars. It gets recycled, melted down, and reused. But industrial silver? Once it's embedded in a circuit board or a solar panel, it's economically impractical to recover. A Tomahawk missile contains about 2 to 3 pounds of silver. When it explodes, that silver is gone forever.
That's a critical difference. So demand keeps rising because of industrial use, but supply can't keep pace?
That's where it gets interesting. The Silver Institute just released their forecast for 2026. This will be the 6th consecutive year of supply deficit. 6 years in a row where global demand exceeds supply. The cumulative deficit from 2021 to 2026 is over 762 million ounces. That's equivalent to nearly an entire year of global production.
762 million ounces drawn down from stockpiles. Where's that silver coming from?
Above ground inventories. But here's the problem. Those inventories aren't infinite. The Silver Institute uses a phrase in their report, era of reduced stocks. That's their diplomatic way of saying, we're running out of easily accessible silver. And despite prices averaging over $40 per ounce in 2025, a 42% increase from the previous year, mine production is barely growing.
Wait, that doesn't make sense. Economics 101 says higher prices should bring more supply to market. Why isn't that happening?
Because silver is primarily a byproduct. About 70% of silver comes from mines that are primarily digging for copper, lead, or zinc. The miners aren't motivated to expand production for a byproduct. And here's where it gets even more counterintuitive. When silver prices get very high, some miners actually reduce silver output.
Reduce output when prices are high? That's backwards.
Peter Krauth explained this in the interview. When silver hits high prices, miners with the option will shift to lower grade ore. They can mine less silver, make the same or more profit because of the high price, but bring less physical silver to market. It's the reverse of normal economics. High prices can actually mean less supply.
So we have rising industrial demand, shrinking inventories, and supply that doesn't respond to price signals. That sounds like a powder keg.
And sitting right on top of that powder keg is the paper silver market. This is where JP Morgan comes in. In 2020, the Commodity Futures Trading Commission fined JP Morgan $920 million, the largest penalty in CFTC history at that time, for manipulating precious metals markets from 2008 to 2016.
Almost $1 billion. What were they doing?
It's called spoofing. Traders would place hundreds of thousands of fake buy or sell orders to move the price, then cancel those orders before execution. They created false signals of supply and demand to trick other traders. 2 JP Morgan traders went to prison in 2023. But here's the disturbing part. In February 2026, when silver crashed 32% in 2 days, the largest drop since 1980, the same manipulation accusations resurfaced.
Same bank? Same playbook?
The pattern looks similar. During the crash, physical silver in Shanghai traded substantially higher than US futures prices. That tells you the collapse was driven by paper selling, not actual supply. Real buyers in China were still willing to pay premium prices for physical metal, while paper prices were crashing in New York.
This is exactly what we talked about in episode 200 with the bond market. When paper markets and physical markets diverge, the physical market is telling you the truth.
Precisely. And Robert Kiyosaki made a point in the interview that's worth repeating. He said JP Morgan was fined almost $1 billion for selling silver they didn't have. And guess what? Nothing's changed. They're still doing it. They're still selling silver into the future to keep prices suppressed.
But if they're selling silver they don't have, at some point they have to deliver, right? They have to cover their short positions?
That's the end game. When enough people demand physical delivery instead of rolling their contracts forward, the game ends. This is what happened during the GameStop short squeeze, but in a much smaller market. Silver is tiny compared to stocks or bonds. When the short squeeze comes in silver, it could be explosive.
Corey, I want to go back to something you said earlier. If silver is so strategically important, why isn't the government stockpiling it like they do with oil or rare earth elements?
Great question. They used to. The US government maintained a strategic silver stockpile for decades because of silver's importance in photography, electronics, and national defense. But they sold it all off between 1959 and 2002. Today, the US government has essentially zero silver reserves while simultaneously increasing its dependence on silver for military applications, green energy, and advanced electronics.
That seems short-sighted.
It's worse than short-sighted. Meanwhile, China, which doesn't publish official silver reserve numbers, has been accumulating through the Shanghai Gold Exchange. Remember from episode 200, we talked about how Shanghai silver prices had a 12% premium over Comex? That premium exists because China is vacuuming up physical silver while Western investors are trading paper contracts.
So, there's an East-West dynamic here too, just like with gold.
Exactly. And it ties into Gresham's law. Western financial institutions are content to trade paper silver, the fake money. Eastern buyers want physical silver, the real money. Over time, the physical metal flows east, leaving the West with contracts and promises.
Let me ask you this. Peter Krauth and Robert Kiyosaki are extremely bullish on silver. Kiyosaki predicts $200. Krauth talks about silver potentially reaching $300 to $400 if the gold-silver ratio returns to 15-1. Are those realistic targets?
I think the direction is right, but those specific numbers require some context. The gold-silver ratio right now is about 55-1. That means it takes 55 ounces of silver to buy 1 ounce of gold. Historically, before the Industrial Revolution, the ratio was closer to 15-1. Krauth's calculation is, if gold goes to $10,000 and the ratio returns to 15-1, silver would be over $600.
$600 sounds incredible, but is a 15-1 ratio realistic in the modern world?
Probably not. The ratio averaged closer to 60-70 over the past few decades, and even hit 50, briefly, in January 2026, when silver peaked at 121. A return to 15 to 1 would require a massive revaluation of silver's monetary properties relative to its industrial uses. I think it's more prudent to think about silver as a wealth preservation tool with significant upside potential, rather than betting on a specific price target.
So how should people think about silver allocation?
First, recognize what you're buying. Physical silver is wealth insurance, not a get-rich-quick speculation. It's part of your wealth emergency kit. Second, understand the difference between physical and paper silver. A silver ETF gives you price exposure, but do you truly own the metal? Can you touch it? Can you take delivery if the system freezes?
That's the touch test we always come back to.
Right. Proverbs 11:1 says, "Dishonest scales are an abomination to the Lord, but a just weight is his delight." J.P. Morgan's spoofing scheme was literally dishonest scales, creating false weights of supply and demand. When you own paper silver, you're trusting that the scales are honest. When you own physical silver in your possession, you are the scale.
What about the argument that silver doesn't pay dividends or interest, so it's a waste to hold it?
That argument only makes sense in a world where currency maintains its value. But we're not in that world. We're printing $1 trillion every 100 days in the US. Every major currency is being debased. In that environment, silver isn't generating zero return, it's preventing negative returns. Your silver isn't growing in value. Your dollars are shrinking in value. And silver is holding its purchasing power.
Haggai 2-8. The silver is mine, and the gold is mine, declares the Lord.
When governments run out of options for their debt crisis, when the only solution is to inflate the debt away through currency debasement, what protects your wealth? The currency God created. Silver and gold were money for thousands of years. The last 50 years of pure fiat currency is the experiment. And that experiment is showing cracks.
Let's talk about the volatility again. That 32% crash in February that had to shake out a lot of holders.
Absolutely. And that's part of the process. Markets don't move in straight lines, especially silver. The crash likely forced out leveraged traders, weak hands, and people who were treating silver like a short-term trade rather than a long-term position. But notice what happened after the crash. Silver found support around $70 to $76. It didn't collapse back to 40 or 50. The physical market provided a floor.
Because real demand still exists.
Exactly. Industrial users still need silver. Asian buyers still want physical metal. The structural deficit hasn't changed. The volatility is noise. The signal is the 6-year deficit, the era of reduced stocks, and the growing disconnect between paper prices and physical availability.
What about silver mining stocks? Both Kiyosaki and Krauth mention them as leveraged plays.
Mining stocks can amplify gains when silver rises, but they also amplify losses when silver falls. And here's the critical point they both made. Mining stocks are still inside the financial system. If there's a banking crisis, a stock market freeze, or capital controls, your mining stock shares are at risk. Physical silver in your possession is outside the system. That's the ultimate insurance.
So the allocation strategy is physical first, mining stocks only as a small speculative position.
If at all. I'd say 90% or more of your silver allocation should be physical metal. If you want to speculate on mining stocks, keep it to 10% or less of your precious metals portfolio. And remember, mining stocks crashed along with everything else in 2008, even though silver rebounded strongly afterward. Don't confuse leverage with safety.
Corey, one more question. The Silver Institute forecast shows industrial demand actually declining by 2% in 2026. Doesn't that contradict the bullish thesis?
Good catch. That's a short-term headwind, not a structural reversal. The decline is primarily from the solar industry, where manufacturers are thrifting silver, using less silver per panel through technological improvements. But here's what matters. Even with demand softening, the market is still in deficit. That tells you supply is extremely constrained. And long-term, the electrification of everything EVs, renewable energy, advanced electronics, keeps the structural demand story intact.
So short-term noise, long-term signal.
Exactly. And this is where having the right framework matters. If you're treating silver as a short-term trade, that 2% demand decline might scare you. If you understand you're holding silver as a 10-year wealth preservation strategy, it's just data. The structural deficit is what matters.
What should listeners do right now with silver at $76?
First, don't wait for a perfect entry point. We've been saying this since episode 200. The time to build your wealth emergency kit is before the crisis, not during it. In 2008, when people wanted to buy physical gold and silver, dealers were sold out for months. Premiums spiked to 3 to 5 times normal levels. Right now, you can buy at reasonable premiums. That window won't stay open forever.
And within the physical silver category?
Government-minted coins like American Silver Eagles are recognized worldwide and carry slightly higher premiums but maximum liquidity. Silver rounds and bars are cheaper but require verification when you sell. I like both. Eagles for easy transactions, bars for bulk storage. The key is, buy what you can verify and what you can actually take possession of.
Not a pooled account or unallocated storage?
If you can't touch it, you don't own it. That's the rule. Allocated storage with a reputable vault where you own specific bars with serial numbers? That's acceptable if you need large-scale storage. Unallocated accounts where you own a claim on a pool of metal? That's paper silver dressed up as physical. Avoid it.
Last question, Corey. Robert Kiyosaki has been buying silver since 1965. That's almost 60 years. What can we learn from that kind of conviction?
2 things. First, real wealth isn't built on timing the market perfectly. It's built on understanding value and accumulating it consistently. Kiyosaki didn't buy silver at the perfect bottom. He bought it when he recognized the currency was being debased, and silver was real money. Second, wealth preservation is a marathon, not a sprint. He held through decades of stagnation, through the Hunt brothers' manipulation in 1980, through the crash after the 2011 peak, and today, he's still buying.
Because the thesis hasn't changed.
Because the thesis has only strengthened. Governments are more indebted than ever. Currency debasement is accelerating. Industrial demand for silver is structurally higher. Above-ground inventories are depleting. The paper games can't last forever. When JP Morgan and the other bullion banks finally lose control of the paper market, physical silver holders will be vindicated.
Proverbs 22:7. The borrower is slave to the lender. When you hold paper silver, you're the borrower of trust. When you hold physical silver, you're the lender of nothing. You own it outright.
Beautifully put. And that's the ultimate distinction. In a world of $39 trillion in US government debt, in a world where central banks are trapped by financial addiction, in a world where the new Fed chairman is changing inflation measurements to hide the problem, physical silver is a declaration of independence. You're opting out of the debt-based system and into a value-based system.
The strategic metal of the information age.
Iron built the industrial age. Silver powers the information age. But unlike iron, silver is also God's money. It's both the tool that builds the future and the insurance that protects you from the past's mistakes. That's why it's unique. That's why the supply-demand imbalance matters. And that's why a 762 million ounce deficit over 6 years is sending us a signal we can't ignore.
We plan, God provides. Don't wait for the crisis to prepare for the crisis.
The banks have been manipulating this market for over a decade. They've paid over $1 billion in fines. 2 traders went to prison, and the manipulation continues. But the physical market doesn't lie. When Shanghai trades at a 12% premium to Comex, when Comex registered inventory drops 38%, when 6 consecutive years produce structural deficits, the endgame is approaching. Be on the right side of that equation. Own the real metal, not the paper promise.
See you next time.
See you.